maximizing our DeFi portfolio, right? Like a lot of the infrastructure that we've built, like 3 or 4 years ago, it was all like sci-fi. That we're gonna have this self-sovereign money layer where we're gonna do all these complex financial operations on chain. That was sci-fi. That was like impossible. There was like a lot of stories and talks and hypes and vaporware that was released. But now at the end of the day, we have a thriving DeFi ecosystem now with over $100 billion like in assets, right? So it's only growing. Yeah, I'm Amadeo Brands. I'm the co-founder of YieldNest, and my background is in crypto. I've joined crypto. I first touched crypto in 2012, and I didn't fully understand it. But in 2015, I went full time into crypto, and I was working for the first the Dutch crypto hedge fund, and the oldest crypto hedge fund actually in the Netherlands. I worked there mostly to manage to build software to manage their assets and to manage all those complexities. Then I started DeFi Capital, which went very well, and that exited that. And then I worked for a bunch of DAOs like MakerDAO, Curve, started the Llama Risk team. Yeah, so that's a little bit of my background. So I'm very deep enshrined into DeFi and crypto assets. Fun fact is like 3 years ago, I called the top of the last cycle. So I made a prediction with the DeFi Capital fund, and we had this target click strategy, which I will explain more about. And I basically called the right targets. All right, let's move now into the current state of DeFi. Where are we, right? Like, what is going on in DeFi? Well, there's a lot of commotion. We built all this beautiful infrastructure, and what do we get? It's a bunch of meme coin trading and monkey brains and monkeynomics, I call it. And there's a lot of distractions now, right? And sometimes I also ask myself, like, well, we're building all this complex infrastructure, but nobody seems to care, right? But some guy here cares, right? Like some guy is lurking here in the dark. We can see all this commotion, but the president just got elected has launched a DeFi protocol, right? And you can see the policies of crypto are actually improving. We are moving into a better direction. And actually all the things about like centralized finance and decentralized finance, where we have censorship resistant, programmable, decentralized, and trustless like infrastructures, they become a reality now, and people care about that. And you can see that before there was also a lot of regulatory clampdown on projects that were actually trying to build value add and non-Ouroboros, non short term, just meme coin stuff that is not adding value. Right now, I feel that we're entering a stage where things will add value, right? So you can see here that Bitcoin was the first, and Bitcoin is definitely entering a more mature phase. And lagging behind, we can see the DeFi coins that are that's still coming out of this thought of this disillusionment where they got all hammered. But I think they're all going to come back very, very hard. I always say that we're going from memes to mean reverting, where now it's like meme coins and gaming and decentralized AI, RWA socials, like that's all going to the cycle. And the older cycle of like the DeFi coins, the DePIN, the stable coins, and all these components that have a lot of innovation left, that will come. And I think that will come this cycle, right? Before I dive into like how do we manage our on-chain portfolios, a little bit about things that I learned when I was like managing a crypto asset fund in Amsterdam, actually back in 2015, 16, 17, when I was managing that. This is this cycle here. This is actually 2017. And you can see here we did pretty well with the portfolio, and we outperformed Bitcoin and ETH at the time. And how did we do that? Like, what was our strategy at the time? At that time there was no DeFi. There was just kind of like on-chain asset management. So what you could do is like buy these tokens that have these promises, and then kind of like just kind of hold it or maybe stake it. We were a big Dash masternode staker, the dark nodes, right? So we did a lot with Dash and Pivx and all these older coins that maybe some of you still know. We were very active with that in the past. And the strategy that we used at Cyber Capital at the time was very, we called it like, we did a lot of fundamental analysis, and we're a bit too early with the fundamental analysis, but at that time it really worked. What we did, we looked at different protocols. So we had, when Cyber Capital started, that fund that I was managing, we started with like $500,000, and we went to like 70 or 80 million, right? So that grew like very exponentially. And we had quite a simple strategy. We used 0.1% of our 0.1 till 1% of our AUM. We would inject into projects that we liked. And how do we find projects that we liked? Was just kind of going to the GitHubs, going into the insights and seeing like, okay, what are the developers that are working on it? What are the GitHub commits? And how do we, what are people actually doing in these projects, right? And it's actually still a valid strategy for today, right? Like if you see a project that you like, you have to check their production and what are they producing, right? And if they closed source, well, like that's very risky, right? So you do want to have projects that are open source where you can actually see what the developers are working on, what are they working on, who are the developers that are working on it. This is a screenshot from our own protocol, but you can see here there's a lot of healthy development that you can see, and you can see, okay, people are developing, there's other new developers that are coming in, and that's what I liked to see that back then in 2015, 16, and 17. And what we did, as I said, we inject 1% of our AUM or 0.1% between that range. And then we would inject it in projects and we would like track their GitHub commits, check their social queues, and then either like determine if the price would go up like by 50% or 100%. We would either double down on the bet if we see more activity. If it was like just the pump out of nowhere without any activity, we knew like something maybe is wrong, so we would potentially exit the position if we get like a big pump, right? So this is one of the strategies we used back then. That was very effective then, but then of course we thought we were very smart and oh, we have this really cool strategy, and then the bear market hit, right? And then it's like we had this really cool strategy. We would examine projects, but like it doesn't really matter if you have a huge downward trending market. You cannot, like, it's hard to hedge as a crypto fund. Most crypto funds are long only and still are mostly long only. They're not really hedging, so it was maybe not even. The hedge fund wasn't maybe the right word, but you want to hedge your bets, but it's hard to do that. So these strategies always change. You always need to be very, very adaptive, right? So then what I did at DeFi Capital, so that was like my next fund that I was working for, we had this target click strategy, right? I was just explaining this in this video 3 years ago. I was explaining this target click strategy, and when I was presenting the video, we were at like target number 2 or 3. And actually after the video, just all shot to target number 6. And the fund completely exited and gave back the funds to the investor. And it was like a whole good cycle. And what we were doing at DeFi Capital was actually a very simple, basic strategy. And it was just very effective, around 800 to 1,000% yield. And we would just hold Bitcoin, ETH, MKR, and ynFinance tokens at the time, because it was a DeFi fund, right? And then we would use the MKR to use the Bitcoin and the ETH to have a reserve and to lever up like a 2x, 3x leverage when we saw the market was getting into this target stage. And then we would build down the leverage if we would see the markets entering his like the top of the cycle, and we exited. And of course, we didn't call the top like perfectly, but it was within the range of these targets, right? So, all right. So now let's jump in with that background and the information that you see. Like, okay, these are 2 funds that I managed, and when I was managing the DeFi fund, I always thought to myself, like, I wish like we could just put this into some sort of a token. We don't have to, like, if you wrap like this whole institutional wrapper around it, there's a lot of bureaucracy around it, right? Like I want to put these things on chain. I want everybody to use these tools, right? And that's where we're moving now with, you know, like if we're trading on chain and with all the tools that we have at hand, we can manage all our assets on chain, and we can do all these instruments ourselves, basically, right? Yeah, these are like some of the tools that I'm using, right? So DBank, Tenderly, DeFi Llama, DEX Screener, like TradingView, GitHub, the multi-sig cold storage. You need to have information and knowledge about all of it, right? But who's a power DeFi user? Who's like storing most of their wealth on a ledger, basically? Or there we go. There's a lot of people who are doing that, right? So you want those assets to always be productive. And what I learned in my role as a fund manager and managing also my own crypto assets, don't panic, and always make sure to just like very disciplined, like write down what you want to do, have a very clear opinionated strategy where you want to like be sure that like if I like I hold ETH or I hold Solana or Bitcoin or whatever you have, like make a plan for that. Don't just go in and out and try to do 100x leverage or something. That's how you get burned. Just think a bit longer term. It's like, hey, there's a presidential election that has happened. Trump just won, and the whole like Senate flipped more positive on crypto, right? So what's going to happen? Well, I think the cycle, right? This is the cycle repeat chart, and we're not right here. And if you overlay that with the previous cycle, you can see that we potentially would go to like 300K, right? In this cycle, right? So like you could say here is the next stop, and it's an overlay strategy where you can see like, okay, what is potentially going to happen, right? So now buying a bunch of meme coins and hoping they would go up, like I think that's the wrong strategy. I think what's better is to make a convicted, focused bet on like, okay, I think ETH or Bitcoin, that is probably going to perform well. Well, let's construct my portfolio in such a way that I trade these assets, because with that you can already have 50 to 100% like yield, which is great, right? And then if you want more on top of that, you can maximize these assets, and that's I seen as like the best strategy after all my years of research. And actually, with the Cyber Capital Fund, we did a lot of shitcoins basically as well, right? We did a lot of like smaller shitcoins, and that like crashed the price here as well very hard. So you want to have these blue chip assets, and then try to get maximum yield by maybe doing lending, borrowing, doing LPing, doing maybe some farming, and that will require a lot of like attention and maintenance for now. So where I think DeFi is going to go is basically potentially to a stage where it's a little bit more abstracted away, and there's a couple of professionals like are here in the room that understand all these DeFi tools, and we will use DeFi how on the background, and then we will make it, we're constructing a lot of instruments to make it easier for the next wave of new users to come in, right? I think that we hit a wave where there's people that understand all these tools and people that want to go this deep. But I think a lot of them, they probably want to use DBank, but I think they will prefer to have a couple of simple assets and maybe play around on a more simpler level, right? That's where I think it's going. But for the more advanced users, I would recommend to have a plan and basically do this trade. That would be my advice for just most of your portfolio. Do momentum trade with blue chips, allocate 80% to the blue chip assets, 20% to like some experimental assets, right? So what I mean with that is just you buy Bitcoin, ETH, and maybe some other like high market cap assets, combine them into certain different yield plays. With these, what I mean with these yield plays is that you want to get the max yield on these blue chip assets as well, because you can get like the ETH upside. But if you already simply stake your ETH, you already get even more, right? But then if you stake your ETH and loop it, you even get more. And if you then restake it, you get even more. You see, and it kind of keeps on going like that. It becomes more complex and complexer to use. But I would say the simplest thing, 80% blue chips and then 20% experimental. Rebalance it weekly or monthly based on your strategy. And don't act on an impulse. Just be calm, like, okay, this is my strategy. I now feel the biggest thing that I learned as a portfolio manager is like if I'm managing my portfolio, I wake up and there's all this drama on Twitter that happens all the time. There's something happened and it's like, oh my God, the world is burning down and crypto is going to fail now, right? Like it's happened so many times. Just calm down, write down, like I feel bearish. Like that's what I'm doing. Like every day I have like this notebook, journaling basically a little bit, right? And it's like, okay, today I'm feeling like bearish. I want to sell, like I want to rotate back into stable coins, right? Where I will come next, right? So have discipline, don't act on impulses. Yeah, then as I already said, like maximize your yield. Aim to secure the highest yield on your assets, right? Don't miss out on it. Like but be careful. Be careful to not go into too experimental components, right? Like if you have your blue chip stack, go to Aave, go to Curve, go to Uniswap, use these blue chip tools. Don't get too carried away by this new thing that gives you 1000% yield and stuff like that. You can do that, but then do that with that 20% back, or maybe with 10% of your blue chip back. That's fine, right? But don't go all into these things. Like if there's a new Celsius that offers this yield or something, like watch out, because every percentage yield that you get, there's always some risks involved, right? Yeah, and then the best thing, like as I said before, like You can be the best like momentum trader or have all the discipline in the world, but if you don't have this cycle also in mind, because like especially crypto is a new asset class, right? It's a new innovation. There's a lot of market asymmetry, and you can have a lot of unfair knowledge advantage by just understanding crypto. Most people in the world do not understand crypto, right? But because of that, we still have heavy cycles, ups and downs in the market. So like at some point the market can crash down 80%, right? And it can still happen because we're not at the stage that we have this super global adoption, right? There's still a lot of work that we need to do as an industry. So be aware of that and never fully exit the market. So never completely exit everything. That's also the mistake that I made one time before as well, that you just like panic completely and execute. No, don't do that. Like have this strategy where you, in my opinion, that you have to feel yourself what you think is best. But in my opinion, just like have always like 10 or 20% in the market. And then scale it, what I say here, right? The stable coin to crypto split, right? In the bull market, I only hold like 10% stables, and I go full in 90% like in like different crypto assets. And then in the bear market, I would hold 90% stables and only 10 to 20% like in crypto, right? And personally, on the sides, I'm building this kind of like reserve in these long tail blue chip bags, right? Like it's as simple as that. I think the way to survive longer term in these crypto cycles is not going for the next big like meme coin or whatever. Just play it a little bit safer, because this new asset class is explosive and is bound to happen. Watch out to not get overtaken by your monkey brain, because that's what happens to a lot of people. And you basically need to put systems to protect yourself in place, that you cannot just do an extreme like trade or something, right? All right, yeah. Moving forward from there, right? And like as we hear, like they're solving the fragmentation issue, right? So there's a lot of fragmentation in the L2s, the L1s, Bitcoin Core, ETH Layer 1, Solana. All these systems are all not working together, right? That's annoying, right? That's hard to build and hard to manage. But it's even hard to manage on ETH L1, for example. You also have a bunch of opportunities, right? You have yield applications, you have DEXs, you have then restake applications, staking applications. Actually, this chart goes on and on and on and on. And then, like, we are expected to understand all of this. When in 2015-16, when I was managing the cyber capital, we actually would know the whole top 300 or top 500 of all the coins on CoinMarketCap. There was no CoinGecko at the time. We knew all of it. We knew all of the assets, right? I understood all of them. Right now, there's so much that I actually personally cannot keep up anymore, right? It's too much. It's getting too much. So we need to solve that by consolidating, right? And that's, I come now a little bit to the YieldNest, like what YieldNest is doing and what we're currently building. The solution for that is like, we call it like max LRTs, and it's like a liquid restaking token to kind of keep the security. And then we have a bunch of underlying assets. And what we do, we take actually productive assets of users. So let's say you have rep staked ETH, you have staked ETH, or you have SDAI or SUSDE or whatever. We are building max LRT vaults to restake these assets and do some very low risk DeFi strategies, and then take that max LRT and also give that more utility again, right? So you can see that's like, if you're in traditional finance, you have a money market account, or you have your fiat, and then from your fiat you go to a money market account, right? Okay, wow, that's the whole thing, and you get like 10% yield, that's it, right? But in DeFi, it's so cool because we can wrap these instruments and other instruments and even wrap it around each other, and we can go insane and go very extensive with all these different strategies. So what we're doing here, for example, with our ynETHx strategy that is now live on mainnet, we already have around $20 million in TVL on our native ETH restaking, and we built this kind of max LRT vault that rebalances between restaking protocols, eigenlayer, symbiotic, nectar, etc., and kind of rebalance the assets over the best yielding position. And then you have on top of it, you have an asset that you can use in DeFi. You can see, oh, do I want to lever this up? Do I want to maybe hedge it? Do I want to, and then it becomes more simple. That's my in my opinion, the best solution. With all those assets, right? You can see here, like you have all these different assets, right, that you can hold, or what we just discussed, like all these different stable coins that earn a certain yield, or all these different like liquid staking derivatives. We package them into one token and we get the max yield for you. And then this token also stays liquid, so you can use it in other things. And on top of that, you're earning a bunch of other yields out of this as well. YieldNest is specialized in restaking. And for me, as a long-term in crypto, why did I like restaking a lot? Because I was actually quite a big fan of merge mining. And this is kind of like an evolution of merge mining. And even Satoshi Nakamoto himself was like, ooh, we can extend the security set of Bitcoin with merge mining. Merge mining didn't work for some technical reasons that I can get into if you guys want. But with restaking, it does work because there's something at stake, right? And then we can export this to a bunch of other services. So we can build the whole mortgage-backed security market basically now on chain with restaking and risk underwriting and risk curation of different capital assets, right? And RWAs would fit actually on this side, right? So what could happen indeed is that there would probably be some sort of a ynRWAx or something where we like combine all these different RWA instruments. Tokenized bond, but what's important for me, and I hope you guys see that, there's a denominated asset. So you can see here, there's an ETH denominated asset, BTC denominated, and USD denominated, right? Why do BNB denominated? Why is that important? Because then you have this one accounting assets that you maximize. You know that USD is probably not going to go below $1, right? Like that's going to happen, and BTC stays a BTC and ETH stays a ETH. So you understand the dynamics, right? So behind this, there's a whole ETH dynamics, right? The whole issued ETH had some issues. ETH didn't really perform that well in this cycle yet. Probably it will do much better moving forward, I hope, right? But then you have this isolated, so you know, okay, I focus here on ETH, I focus here on BTC. And actually, yeah, it's a good point. Do we use RWAs? Well, I think here on the USD side, right? So you have here the different restaking strategies. And underneath that, you could have RWA strategies, or you have RWA assets that you add here, right? So, like, yeah, there could be two ways, or a specific RWA LRT that we would build. Right now, my opinion on RWAs, like, I mean, you can just buy bonds, which is easy, right? You can just buy a bond, 5% yield. Okay, sure, that's what MakerDAO did, right? In their kind of cocoon period. MakerDAO cocooned, they waited, and now the sky launched, right? But they were raking in a lot of money by just arbitraging those treasury yields, right? It was great for them. But generally, like RWAs, I think the risks of that are also kind of big, right? Because a lot of RWA protocols that I see, they just hash like contracts on a blockchain hash, right? That doesn't mean anything. Like if somebody tells me like, oh, hey, I have this token, I want to claim this I want to claim this bond. Like, okay, who's enforcing that, right? Nobody, right? So I see a lot of unseen risk still with RWAs, but I also see a lot of potential because RWAs will connect this real yield and hopefully at some point maybe like we go lending and borrowing, like we merge my vision was, and I thought it would already happen, but that on-chain and off-chain lending and borrowing yield, right? Yeah, but that needs to happen, right? Like, and I mean, and the thing is that I actually worked on projects that tried to do this like 2 years ago. Right, it was too early, but maybe now it's time, right? Because there's all these regulatory uncertainties and blah, 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 but that's definitely amazing, right? If we're going to merge the on-chain and off-chain yields, when the bond yields go to like 2%, and it's like, okay, or now 4.5% since yesterday, we got another rate cut, right? So then more money will move on-chain because now stablecoin yields are like between 10 and 15%, right? So you can earn quite a lot there. Yeah, and we do that multi-chain. That's actually kind of like a new innovation that we do because I don't know if people are familiar with coprocessors and the glue coprocessors, how we call it. So we're not only doing this like, oh, you know, the ETH yield on ETH L1. No, we're gluing all these different opportunities together into one asset, right? So it could be that on Arbitrum, for example, we see, because we have these underlying assets. So we have rep staked ETH or I see a spelling mistake here. Rep staked ETH, staked ETH, staked frax ETH, METH, whatever. Like these assets, they are combining into these instruments. But a lot of times you can see on ETH L1, you get ETH L1, you have the rep stake ETH trading for $3,000, but on Arbitrum it sometimes trades at $2,900, right? So you can have an ARB in between in your underlying asset basket, right? So there's a lot of yield to be made. And you can do a lot of lending and borrowing arbitrages where you loop certain, like if I get 5% yield, I have a token that earns me 5% yield, and I can borrow, I can use the token as collateral, and I can borrow the same denominated asset token. So for example, I take ynETHx, and I can borrow restake ETH against it for 0.5%. Yeah, of course I'm going to do that, and I'm looping that because that's basically free money, right? But then you need to always keep track of all your funding rates and stuff like that, and that's like automated. And we do that multi-chain across all these different chains, right? Like, and that's now we're working that out, and a bunch of DeFi strategies, right? So we're combining multi-chain and DeFi strategies all combined into this one asset that will give you this max risk-adjusted returns. And with risk-adjusted, I mean we're not going to give like 200% or 50%. That's also not what you want, because if you get that, there is somewhere a lot of risk, right? That people are not seeing and not pricing. So it's probably between 8 and 15%, something like that, right? Maybe it overshoots to 20 or 25 at some market conditions, but I assume between 8 and 15 as a really base denominated asset. And then that will just go across all these chains, across all these different DeFi opportunities, with kind of a cornerstone in restaking to, and why restaking, right? In restaking, we can secure all these kind of different swap routes and all these different operations that we need to do. But anyway, as what I described in the beginning of the slides, is that this whole network, right? Try to see like how can we build a stronger network. I always say to people like, stop staking at banks or traditional finance and start maybe restaking on a better system that we all believe in, right? Think of it like that, right? That's what we're doing. Like if you put your money into a fiat bank, like you're helping this corrupt, broken system. And if we're staking it in the good services, I don't mean like, oh, let's go to Blast or some other like random, like really pumpy, dumpy meme coin bullshit. That's actually just more destructive for the industry, I would say. But if you have a longer term mindset, okay, maybe I want to put my maybe I want to put it in some velodrome or in some curve pool or something where, oh, I really like this automated market maker infrastructure, and that's where I want to put my monetary energy. That's where I want to put my value. And then at the end of the day, that's also how you earn money, right? If you do positive things, you will receive positive things back. Yeah, one last thing, like I did a new prediction. So I did a new prediction like 6 months ago. It didn't play out, like but 6 months ago we were in this a little bit hype, like buller cycle again, and I kind of did the conservative scenarios. I think we're gonna go to around 12K for ETH and around 100K for Bitcoin in this new 2025, 2026 cycle, I think. But it can be even like if you do optimistic or moderately bullish scenario, you can even go higher. But yeah, these are my price targets for this cycle, and let's see how that all will play out. It's looking very bullish today because like you can see the cycle repeat here, right? And if we look back at the previous cycle, this was like 6 months ago, this chart. And now what happened, we went a bit more sideways, but then eventually now we're again in upward momentum. So I'm moderately bullish, actually. I'm getting more to this scenario here. So yeah, let's see. It's going to be very, very exciting time. Yeah, be sure to follow YieldNest on Twitter. There you can also get the recording, and you can ask us all the questions you want, and you can try out our Max LRT products. And I would always happy to review any portfolio or answer any questions anybody has. We'd be happy to go over that. Yeah. Thank you. All right. Thanks. Thank you. Thank you.